What if your client's ETF trading costs are costing them more than the expense ratio suggests, especially in today's turbulent markets? I'm Patrick Hooper. In this video, we're diving into how surging volatility is reshaping ETF trading costs and investor behavior in 2026. We'll explore how volatility is widening bid-ask spreads and increasing ETF costs, what smart strategies advisors can use to navigate execution, and what ETF flows reveal about investor behavior. Over the first quarter of 2026, market volatility has risen meaningfully amid heightened geopolitical uncertainty. The VIX, a measure of equity market volatility, has more than doubled, while the MOVE Index, a measure of U.S. bond market volatility, has increased by nearly 75%. For ETF investors and the advisors who serve them, this volatility has translated into wider ETF bid-ask spreads and greater premium discount volatility, impacting investors' total cost of ownership. Unlike traditional mutual funds, where costs are largely limited to the fund's expense ratio, ETF total cost of ownership is driven by two explicit costs: the expense ratio and the ETF's trading costs reflected in the bid-ask spread. For advisors, trading costs can be a meaningful component of overall ETF costs, particularly during periods of elevated volatility. As volatility rises, market makers reprice their risks to provide liquidity in quickly changing markets, which results in wider ETF bid-ask spreads. Importantly, this is not a flaw of the ETF structure. When volatility spikes, spread widen in the underlying securities within the fund, and ETF spreads naturally widen as a result. ETF spreads typically remain only a fraction of the cost of trading the underlying securities directly, underscoring the cost efficiency of the ETF wrapper. In fixed income ETFs specifically, we've also observed a familiar dynamic during this volatility cycle: the appearance of larger perceived discounts in certain pockets of the market. This occurs because fixed income ETF NAVs are often struck using backward-looking valuation, while liquidity providers price ETFs in real time using forward-looking assessments. During periods of rapid market movement, this can create the appearance of larger perceived discounts, which we've seen in fixed income ETFs throughout the first quarter of 2026. Ultimately, in periods of heightened volatility, it's critical for advisors and their clients to focus on sound trading practices. Thoughtful execution can help reduce trading costs and avoid unintended outcomes, allowing ETFs to continue to serve as efficient portfolio management tools, even in more challenging market environments. During periods of market stress, trading best practices become even more critical, as heightened volatility can lead to increased trading costs. There are several straightforward steps advisors can take during volatile markets to help avoid unintended trading outcomes. For smaller ETF trades executed using low-touch orders, using a limit order or marketable limit order can help protect against unnecessary price impact and executions at unintended price levels. For advisors placing larger ETF orders that require high-touch execution, working with a block desk can help mitigate market impact during volatile periods. Fee changes at certain custodians may encourage advisors to use algorithmic trading strategies, such as volume-weighted average price trades, VWAPs, or time-weighted average price trade strategies, TWAPs. While these approaches can be effective for individual equities, applying them to ETFs can unintentionally push ETF prices to higher premiums or lower discounts, increasing trading costs that may not always be immediately apparent. This is where the Vanguard ETF capital markets team can help. We partner with advisors to navigate these trading decisions, helping to identify the right trading strategy to minimize costs for both you and your clients. ETF flows today reflect a market driven more by risk management than return seeking. Amid elevated volatility, geopolitical uncertainty, and shifting rate expectations, Advisors and their clients are using ETFs more tactically to manage exposure, maintain flexibility. In equities, flows remain concentrated in highly liquid, large cap, and broad market ETFs, allowing investors to stay invested while preserving the ability to adjust risk. We're also seeing rotations across growth, value, and core exposures as portfolios rebalance in response to changing macroeconomic conditions. In fixed income, flows continue to favor shorter duration and more liquid ETFs. Ongoing uncertainty around rates and inflation has reinforced the role of ETFs as an efficient way to reposition exposure without having to trade directly in less liquid bond markets. For advisors, the key is interpretation. Large ETF flows don't always signal long-term conviction. They can often reflect tactical reallocations, rebalancing, or transitions between exposures. ETFs are being used as a portfolio management tool, providing liquidity, cost efficiency, and implementation flexibility, rather than as outright directional bets. That dynamic makes execution especially important. In volatile markets, trading costs matter. Advisors who stay focused on client objectives, practice disciplined execution, and understand why flows are occurring, not just where they're going, are best positioned to guide clients through today's market environment. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.